Hello, everyone. Welcome to What's Trending. Kirsten Chang here, Senior Industry Analyst at TMX VettaFi, and I'm joined today by my colleague, the lovely Cynthia Murphy, Investment Strategist at VettaFi. Cynthia, how's it going? How are you today?
I am great. Thanks for joining forces today to talk about the markets.
Yeah, excited to dive into some of the latest trends in the ETF business. So, talk about off to the races. We're coming off a record year for ETF inflows, record assets in the business, now more than $10 trillion. And by the way, we've already had a record first quarter for flows in 2025. So, Cynthia, what are some of the biggest trends you're seeing right now?
I have been watching a lot just the equity space specifically. I mean, there's no bigger story than the flows into VOO, which is the Vanguard S&P 500 fund, which is, I think, picked up already more than $65 billion in 2025 alone. That's a record on top of a record plus some. It's huge, huge. And it is just this continuation of this appetite for U.S. equities, but also for equities more broadly. I think what's been interesting to watch recently is that, we started off the year on this massive, crazy pace for U.S. equity demand and for international equity demand more so than we have in many years. But that pace has moderated a little bit. So the numbers are record, but there's some concern brewing in the market, and we know why. So much uncertainty, the tariff conversation that never ends. All these things we don't know how they are going to unfold. So we're finding that while we're at record pace for equity demand, things have moderated a little bit. That is until this week when NVIDIA reports great earnings, and now we're all super positive again. So it's been a bit of a roller coaster ride for sure.
Yeah, definitely. Never a dull moment in the equity market. I do want to pivot to some of the fixed income flows as well, because we're pacing for another record year in active fixed income ETFs. Just a lot of confusion right now over the direction of Fed policy, just how sticky inflation really is. But we're seeing huge success in some of these products from Fidelity. They have that investment grade securitized debt ETF. T. Rowe has a bond ETF that's just seen assets triple right out of the gate. You remember we just had our income investment symposium, Cynthia. A lot of advisors are scared to take on more duration risk right now, right? But kind of a mixed picture on sort of taking on more credit risk. So a lot of those credit sensitive instruments just saw record outflows in April, but I think we're starting to see confidence creep back into the markets in some of those products.
Yeah, it's been kind of like a tale of two cities, if you will. If you have that appetite for equities, which are your risk asset, but then on the fixed income space, I think SGOV, which is the short-term, ultra short-term bond ETF, is like the second most popular ETF of the year. It's kind of fascinating. And then you sprinkle on that, there's new demand for IBIT, which is Bitcoin. So it just really, I think, speaks to this. We need offense, but we need to make sure we have plenty of defense and sprinkle something on top for a diversification alternative. It's been a challenging year for markets. What's rewarding to see is that appetite for ETFs as the tool to implement whatever the direction they're going is really encouraging. And these record flows numbers show that.
Yeah, and we're having record launches, record new products in the marketplace. I think as advisors get increasingly sophisticated, they're looking for these more, fine-tuned objects to help them kind of pinpoint their exposure. And just going back to bonds for a second, I got to talk about munis a little bit. We're getting a lot of love for munis, right? They're just so dang cheap right now that everyone seems to want a slice of the muni pie. So maybe don't write off those sleepy rainy day funds just yet.
I know it's been the story that I think surprised all of us, how much question and how much interest we're getting on muni bonds this year. So it's kind of interesting. Another category that has been really interesting this year is that defined outcome, derivative, structured protection type of strategy. And I think it's kind of for two reasons. One is that income generation, that, it's a kind of a defensive type of play, you're securing that income, but also is kind of, capital preservation play on that equity exposure. I know you've done a lot of work looking into that space recently. What are some of the trends you've seen there?
Yeah, no, you're right. That's another area that's just seen explosive growth. We're talking $100 billion in inflows into that derivative income ETF space over the past 5 years. I think more than $15 billion in Q1 of this year alone. So just most of that's been in covered calls. These funds just allowing you to reach for that additional income by collecting those premiums. And obviously JP Morgan continuing to crush it in that space. JEPI's now a $40 billion fund. But we also talk about NEOS a lot. Their S&P 500 ETF just hit $1 billion in inflows this year. So they're doing great. These covered call strategies just really taking off in an environment where, to your point, a lot of folks believe in both a floor and a ceiling to this market. So I think it's really interesting that people are turning to these sort of strategies that keep themselves within a narrower range, but still able to stay in the market and capitalize on the conditions there.
Yeah, and we keep seeing product development on that front as well. Innovator recently launched new products there. Calamos even has one now on Bitcoin. So a lot of exciting product innovation. Kirsten, I think we've covered some of the key trends. Anything we left out?
No, I think that's it for now, but excited to have a front row seat to all the action with you, Cynthia. Thanks so much for joining me.
We're excited. Thanks everybody for joining us for what's trending this month. And check out, etftrends.com, verify.com, and all the many places you can find us in our research. Thanks again, and we'll see you next time.
Take care, everyone.